All right. Good morning, good evening, whatever time it is where you are. Um. Okay, so we're going to be discussing in this video about key levels. Every ICT level that you need to know. All right. You've been studying ICT. I know sometimes it can be discouraging when you don't really know exactly what to do with all the concepts, but I'm going to be showing you key levels here to focus on. What key levels do you focus on? What do you need to know about these key levels? What makes them important? All right. So that's what we're going to be discussing today. And I will take you through multiple pairs. All right. So that you can see that these things work across every single market. You understand? It works in crypto as well. All right. And I'll explain why. It works in crypto as well, although not as precise. All right. All right. Now, if I'll start with this, okay? If you are an economics student, all right, I'm sure you were once exposed to the supply and demand chart, all right? I don't need to draw it on my chart to show you, but if you remember the supply and demand chart, there's always the x-axis and the y-axis, right? So on the x-axis is usually price. On the y-axis is usually time. You understand? So the same way, we have an axis for price here, we have an axis for time. And if you remember, every single thing that was plotted on that chart was based off of information that was gotten from that chart. I hope I'm making sense now. The same way with price action. Every single thing that you're going to interpret from price action or from the market is going to come from this chart and what you already have in it. All you simply need is time and price. You don't need to add anything else. If you are adding an indicator, it should be to just assist your eyes on something that maybe might cost you time, or maybe something that would you're not used to reading normally, or you're not used to interpreting normally in price. Okay. Yeah. So that's basically it. Time and price. So you can see here. Let me quickly put my cursor in demonstration mode so that you can see what we're doing. I don't think, oh, it's probably only on laptop. And if you are wondering why I'm not doing this on the laptop, I simply don't like, I prefer my phone. It makes making content easy for me. I don't have to do a lot of thinking when I want to do it. But let me see. Just bear with me, I should be able to find it. Okay, since you've not found it, but you can you should understand what I'm saying. All right, so let's begin. Key levels. All right, what are key levels? Support and resistance. Okay, a place of resistance is where price will hit and sell. A place of support is where price will hit and buy. You understand? That's as easy as I can make it. All right, so we're going to start with the blocks. Let's start with the order block. All right, now what is the order block? Okay, what is the order block? The order block is simply a change in the state of delivery. Previously, we were delivering buy, but then now we're going to start delivering sell. It's a change in the state of delivery. All right, what does that mean? All right, now to find a high probability order block, it must have either taken liquidity or be at a level, a significant level, or a turning point. All right, let me quickly show you this. So we hit, let me show you the level we hit. All right, I will also explain this level in this video, so stay tuned. This is a volume imbalance. Okay, so I'm going to be extending it right. Okay, for the sake of this class. Now, as you can see, we respected the middle point of this volume imbalance. Now, what makes this another block? The moment we go below this first candle's low, that is the other block. All right, that's the order block. But in real sense, all right, the order block is not just that candle alone. Okay, that's an early entry. The order block is this entire last buy into that area. The last buy starts from this candle on the 22nd of June. All right, as you can see, we bought on the 18th of June, we sold, then we bought again. That was the last point of buying. All right, before we then turned bearish and came below this candle low here. You understand? That was the last point of buying, where you can see the bodies of the candle. Okay, you might be wondering, okay, why are we not using this one? All right, why are we just using this range here? Now, as you can see, the bodies of this candle, all right, is higher than this other candle body. Do you understand? I mean, okay, let me explain it this way. If we are going to look at it as higher low, higher high, and all of that business, right? Just think of it with the candle bodies here. Okay, we had candle body. This candle body was higher than the next one. This candle body higher than the next one. You can then see that these candle bodies are not above these other ones. If not, we would have focused on those ones as the other block. You understand? These candle bodies from the 30th of June and the 1st of July, they are not higher than the candle body on the 24th of June. So take note of that. Alright, like I said, this first candle is just an early entry. Alright, we can use it. Alright, but also take note that the other block is not just that. It started from the 22nd of June. So the moment we went below the low of the candle on the 22nd of June, alright, we have something called consecutive order blocks. What are consecutive order blocks? Consecutive order blocks are just a range of order blocks. You understand? Okay, they are a range of order blocks. That is the actual change in the state of delivery. Alright, previously we were bullish, now we are bearish. You understand? Of a shorty, now we are bearish. Alright, or rather we have assurance that now we are bearish. Okay, but that first candle is an early entry. Alright. Okay, so let's move on to the next one. Let's do mitigation block. Alright, I will need to draw out this one for you. Now, what is a mitigation block? Come on, man. Alright, what is a mitigation block? Why is it not? Wait, give me a second. I think their app is having a little bit of an issue. Oh my god. Just let it load up. Let it load up. Alright, now what is a mitigation block? Okay, think of the market like this. We're making higher high, higher low. Alright, normally we are to make a higher high. Alright, but instead this is what we do. We make a lower high. Alright, then we come and break below this low. Alright, so basically we create a swing high, swing low, swing high, then we break this low, below this low. Alright, now that's the mitigation block. At any point we return to the, take note, at any point we return to the last bearish candle, a bearish candle within the swing low here. Alright, I'm going to go bearish. Now let me show you what that looks like in actual price action. Alright, now we have swing high like I told you. Okay, we didn't form a higher high, we formed a lower high. Alright, now at any point within the swing low, okay, where do we have the bearish candle? You can see it here on the 29th of June. Okay, at any point we return to that candle, we're going to be bearish. You understand? And as you can see, we return to it 7th of July, 8th of July, and what do we have? We sold. You understand? It doesn't have to be crazy amount of momentum, but we did sell. Alright, so for us to talk about that, the next one I would love to talk about is the breaker block. All right, the breaker block is close to the mitigation block. I will see they are brothers. All right, now let me show you what's the breaker block. In this case, we're forming higher high. I'm showing you bullish examples, but please do note, okay, the opposite is going to be for bearishness. I hope that makes sense. All right, we have higher high, higher low. We make higher high. All right, taking out liquidity from here. Take note, the important thing is liquidity we took. Then we come below this low. All right, now in a bearish scenario, the bearish candle or candles within the swing low here, the moment we return to that, we're going to use it as resistance and sell off. Now these levels work. All right, they work all the time. They work. So now let me show you what does that look like in our chart. All right, as you can see, okay, and it's not every time it's going to form in a way you need you anticipate. But let me just show you this. Right, we formed swing high, or let's say we formed this is a bullish scenario. That's why it's not okay. Let me show you the bearish one. All right, as you can see, higher high, right, higher low, higher high. Can you see that? Now the moment we go below this low, okay, now let's look for the swing low. This is the swing low. All right, okay, I think it's important. Let me show you what swing highs and swing lows are first. Now a swing high in price, all right, is a 3 candle formation where we have 3 candles, one in the middle. You're looking at the wicks. Right? Now this candle on the 31st of March 2026 has a higher wick than the candle on the 30th of March 2026. You can clearly see that. All right, and it has a higher wick than the candle on the 1st of April 2026. You understand? So the candle to the left and the candle to the right have lower wicks, all right, than the candle in the middle. You understand? Now that's the swing high. Now what is the swing low? Let's use the example here. The candle to the left and the candle to the right will have higher lows. All right. If you look to this one on the left, right, you can clearly see the low is higher than the one in the middle. If you look to the one to the right, the low is higher than the one in the middle. Very simple and very, very efficient. You understand? So liquidity is found below swing lows and above swing highs. All right. Liquidity above swing highs is called buy side liquidity. Liquidity below swing lows is called sell side liquidity. Very simple. All right. If you want to know the logic behind that, now if you are, let me explain it this way. If you are taking a sell position, let's say you are a support and resistance trader, right, and you keep your stop loss above it, or let me even say stop loss. What order, for those that trade breakout strategies, right, what order will you keep above this high? A buy stop. Below the swing low, what order will you keep below the swing low? A sell stop. You understand? Trying to get an entry the moment price breaks below. But also note, if you are selling this market, right, what type of stop loss will you keep above the swing high? You would definitely be keeping an order there. Your stop loss order there is going to be that the moment price starts to buy and not sell, okay, you want to buy back your sell order above here, all right, so that you can cover your risk. You understand? You're going to be buying the market, all right, to cover your risk. Okay, the same thing, if you are buying here, you're going to keep a sell order that if price begins to sell, all right, and goes against your initial direction, all right, it is going to sell your order at this point there. You understand? So you're not taking much on risk. Okay, if there's a better way to explain it to you, I will try my best to explain it that way. But that's the best I can give you for now. But very, very simple. Now, below this swing low, all right, for the breaker, you can clearly see where's the last down close candle. Where's the down close candle there? Very easy to see. This one here on the 23rd of March. Beautiful. And the moment price return to it, what do we see happen? The bodies of the candle is significant here. So you can clearly see price sold off from it and sold off massively. Return to it again on the 30th of April and sold off again. You can imagine. So amazing stuff. Now let's look at this example here. Alright, let's look at this example here. This is a breaker as well. Alright, the breaker, how did the breaker form? We first of all created a swing low. Okay, we created a swing low. This is another way a breaker can form. Swing low, we then created a swing high. As long as we take liquidity. Alright, take note. Let me show you this. Let me make the breaker definition very, very simple for you. Now, whenever we take liquidity, alright, whenever we take liquidity, okay, and then we now come and take out the high that formed in the middle before coming to come and take out liquidity, okay, within the swing high, the opposite of this will be for bearishness. Within the swing high, the bullish candle within that swing high or candles are going to be a support level for price. Now let's see how that plays out in the chart. I told you the moment we take liquidity, the first place your eye should go to is the swing high that formed within the middle point of us taking liquidity. So clearly see 1, 2, 3. That's the swing high right there. So where is the bullish candle? This one here. Alright. So you can draw it out in time. And let me say this, just the same way we have consecutive order blocks is the same way we have consecutive breaker blocks as well. You understand? So how many bullish candles do we have here? We have 1, 2. So you can draw them together. As long as there's no bearish candle in between, you can just draw them together. So let's see what happened here. The moment price then traded into that breaker block, can you see what happened? Boom! Very efficient. Or very effective rather. Alright? So we've spoken about the breaker block now. Now we've spoken about mitigation block, breaker block, order block. Alright, let's talk about the rejection block. Now what is a rejection block? A rejection block is a 3 candle formation. Alright, you look for it at swing highs and swing lows. Okay, for bearishness you look for it at swing highs. For bullishness you look for it at swing lows. Alright, so for bearishness, let's identify it here. For bearishness, you can clearly see this is a swing high, right? The 24th of June. The high to the left on the 23rd of June is lower than the high to the right. It's lower than the high in the middle. Alright, and the high to the right on the 25th of June is lower than the weak high in the middle, as in WICK. Okay, so then the next thing we're going to be looking for, we're going to be identifying the longest wick. Obviously, it's the one in the middle. Then we're going to be identifying the highest body within those 3 candles. The highest candle body. You can clearly see the highest candle body is on the 25th of June 2026. So how are we going to draw the rejection block? I will show you quickly. We are going to draw it from the body of the candle to the highest wick. That's our rejection block right there. And the moment price trades into it, we are going to use it to sell. You understand? Now let's look for other examples. Let's look for other examples. Now you can clearly see this one as well. This is an example. We have a swing low here. Between the 1st of July and the 3rd of July, we formed the swing low. Okay? Now we're looking for the lowest candle body. The lowest candle body is on the 3rd of July. You can clearly see it. Alright, down to the longest wick. And rejection blocks can be utilized multiple times. Because when price is ranging, it can range between a rejection block multiple times. Can you see how price just dipped into it on the 7th of July and moved? Amazing. Also take a look at what happened on the 6th of July. Dipped into it, moved up, still sold back down into it. Same thing as well. We came down into it on the 10th of July, used it and moved up. Okay? So it's an amazing way to trade. Now we've shown bullish example and bearish example, so I think it's something you should understand now, so that we don't waste a lot of time. Alright? So the next block I would like to show you. Let's see, is there any other block? Is there any other block I would like to show you in ICT's library? I don't think so. Alright, okay, let's look for a bullish example of a mitigation block. Let's look for a bullish example of a mitigation block. Now, take note of this. We have a swing low here. Okay. We went and formed the swing high. We came and formed the swing low here. We didn't take out this swing low. Alright, liquidity was not taken. We then went above this swing high. Beautiful. The swing high that formed on the 20th of May, from 19th of May to 21st of May. So when we took at that swing high, it's very, very important to note. Remember what I told you. The bullish candle within the swing high or candles, the same way we can have consecutive order blocks, we can also have consecutive breaker blocks. Alright? You look at the bullish candle there. Can you see it? These two candles there, and the moment price traded into it, you can see how price is respecting with the wicks here. Boom, boom, boom. Let me draw it out for you. The moment price traded into it, what do we have? Boom, energetic price action. Just moved up. So that is the bullish mitigation block. Now let's move on to fair value gaps. Now what is a fair value gap? Alright, a fair value gap is a 3-candle formation. Alright, now this is a bullish example. I'm sure this is the one that most people are very, very conversant with. Alright, it's a 3-candle formation, right? Let me see if I can. It's a 3-candle formation, okay? We have candle 1 that formed on the 16th of June. We have candle 2 that formed on the 17th of June. We have candle 3 that formed on, on the 18th of June. Alright? Sorry about that. So we have candle 3 that formed on the 18th of June. So you can clearly see that the candle 1 that formed on the 16th of June, the high price went above it and closed with a candle body above it. Then the low of candle 3 on the 18th of June formed, and that low did not come and close up the space between candle 1 and candle 3. So that makes it a fair value gap. Alright, this is a bullish fair value gap. Beautiful. Bullish fair value gap. Alright, so that's the support level. Now in ICT's library, that fair value gap is called a BC. It's a buying imbalance, selling in inefficiency. What does that mean? It's inefficient in sell side delivery. Price was only buying between this point and here, right? On the 18th of June. It was only buying. So there's no selling that happened here. So for us to have an even market, price needs to sell all the way to this high on the 16th of June. You understand? The moment price does that, there's been equal delivery. You understand, of buy side and sell side. Alright? So now let's look for a bearish example. Beautiful. It's a 3-candle pattern. You can clearly see the candle 1 formed on the 1st of July, candle 2 2nd of July, candle 3 3rd of July. Alright? The candle that formed on the 2nd of July closed below the candle that formed on the 1st of July with a candle body. And then the candle that formed on the 3rd of July, which is the 3rd candle, the high did not come and close up this space between candle 1 and candle 3. You understand? Okay? It did not come and close off that space. So since we didn't close off that space, that is a fair value gap. Easy. Alright? Very, very easy to identify. Now, let me add one more caveat. Okay? Let me add a caveat to it. Let me add something that maybe you might not have heard of. Okay? Now, if we have a volume imbalance, alright, let me first of all teach you what a volume imbalance is. Now, just like we have a fair value gap, there are things called volume imbalances. Now, volume imbalances is the space between candle bodies. So you can see this candle on the 12th of May 2026 and this candle on the 13th of May 2026. the space between their bodies is a volume imbalance. Alright, take note of that. That's all you need to know about volume imbalance. The same thing with this candle on the 5th of May and this candle on the 6th of May. The space between their bodies is a volume imbalance. Finish. Alright, now there's something else you need to know. When you have a fair value gap and a volume imbalance, alright, you are going to draw the fair value gap with the volume imbalance. You are always going to draw the fair value gap with the volume imbalance included. You're not going to stop at the wick. You go all the way to the volume imbalance. Alright? Now, when won't you do this? You won't do this if the wick of this third candle on the 13th of May has gone all the way to the 50% of this candle on the 12th of May. How do you measure that? You take your Fibonacci. You take your Fibonacci tool. You measure the whole candle body. As you can see, this candle on the 13th of May, the low end of it did not come and touch 50%. If it had touched it, we will use the wick to draw the fair value gap. We would no longer use the volume imbalance. So take note of that. Take note of that. Alright. Now, something I want to mention here, because I might forget to mention it. Why am I using US dollar index futures? Alright, as you can see, it's the futures market pair I'm using. I'm not using a CFD pair from a brokerage feed like Wanda, alright, FTMO. I'm not using any of those. Why? Because their levels there's disparity. There's a certain level of disparity between the levels on the futures price action and the levels across different brokerage firms. You can check the difference between your brokerage levels and any other brokerage level. You see there will be disparity, especially in the weeks. Alright, the bodies tend to agree, okay, across brokerage firms, but the weeks, alright, they don't agree. They won't have the same price level. The open, high, low and close will be distorted. So what I do is to use the futures price action because it gives me the clearest point to draw my levels, alright, see my levels respected, alright. So that's why I'm using that. Now on to the next. I've taught you about those fair value gaps. Now I've taught you about volume imbalances. Now the next thing we're going to talk about is the suspension block. Alright, I might need to write this one down because there's a lot of noise where I am. It's currently raining, but we're getting this video out nonetheless. Okay, so a suspension block. Let me write that out for you. Suspension block. So this is a suspension block. Now what is a suspension block? A suspension block is where there are three candle formation. Alright? But within the three candles there will be two volume imbalances. Alright? Can you see on the 19th of June down to the 23rd of June? Okay? From the 19th of June to the 22nd of June we have a volume imbalance. Then as well from the 22nd of June to the 23rd of June we have another volume imbalance. It does not have to have a fair value gap within it. You understand? But that space is called a volume, is called a suspension block rather. So that's a suspension block. Now I want you to also note something. ICT treats these levels as fair value gaps. So you will not treat it different from a fair value gap. Take note of that. It treats them as fair value gaps. The same thing here, it can have a gap within. So we have the suspension block here. Alright, this is a suspension block as well as a fair value gap. Alright, but ICT treats every suspension block as a fair value gap. So that's important for you to note. So we've spoken about suspension blocks. What else do we need to talk about? Now I'm going to talk about one that is not commonly spoken about. But let's talk about something else first. Alright, let's talk about weak gap.